There isn't anybody here who doesn't know who Bill Janeway is. Certainly no one who's been at FiRe for the last every year, I think.
I think we're doing 6.
Yeah. If you've been in Alaska doing oil drilling in the Prudhoe Bay area, Bill started and ran the technology group at Warburg Pincus, who were longtime sponsors of FiRe, helped us get launched. And Bill and I have been friends for longer than that. He's currently on the boards of BEA Systems, Nuance, Wall Street Systems.
I have to confess, I have to tell you, it's not a secret. I'm no longer on the board of BEA Systems. The Oracle acquisition closed at the end of April.
You and Larry are no.
No, we're not. We're not collaborators.
You don't get to ride on that carbon knife boat.
Tremendous amount of talent that's been liberated, however.
That's good. I'm glad to hear that. It's one of those creative, destructive moments.
You got it.
You got it. Absolutely. Universe.
There you go.
And today he kind of, in his life of calm, is living part-time in Cambridge, where he took his advanced degrees, and is chairman of the board of the trustees of Cambridge in the U.S. He is founding manager of the Cambridge Endowment for Research in Finance. He is the honorary fellow, Pembroke College, University of Cambridge, and director of the Social Science Research Council. In other words, you're not doing anything at all.
No, it does keep the neurons talking to each other, however, which is very worthwhile.
Yeah. And we have a history that I'm proud of. I say we, you talk, I listen. In looking at, Bill is one of the guys who, A, understands history and the history of economics in a way that almost no other living person that I know does understand. And B, as part of that larger story, early understood risk and the role risk plays in all the things that we do economically. And C, has taken us through a series of years of conversations about risk and the role that risk plays in venture investing, the cycles of venture investing and how they're off from actual risk, and the role of risk in larger equities markets. And we've kind of brought ourselves up to this moment last year, where things were looking a little dicey.
Well, Mark, one of the here's a pitch on behalf of SNS. If you're a premium member, you get to go back into the archives and look at things. Sure. So I cheated late last night, and I went back, and 2 years ago, we talked about risk versus uncertainty, about the difference between risk defined as the volatility of a time series, which is what financial economists and natural scientists tend to think of it as, and the fundamental uncertainty of a world in which the second law of thermodynamics works, time only moves in one direction, and we are dealing with ignorance of the future and the processes which drive the kind of observables like stock prices are not in fact stationary. So we talked about that in some length and raised some questions about where the modern financial economics was taking us, particularly with the growth of the derivatives markets. Right. Last year, we talked very specifically about the buyout boom and how it was driven by the extraordinary explosion of credit derivatives and the notion that no one has to own risk. There's always somebody you could trade it off to. And I think we agreed that this was likely to end in tears.
Yes.
So as you know, we've had some discussion about what we were going to call this conversation.
Right.
And my first suggestion was we just call it, "Told you so." And but then we decided,
never an attractive thing.
Never decided it'd be probably more mature and more thoughtful, more helpful if, in fact, we tried to derive some lessons from what we have been living through, not just in Wall Street, where there are 50,000 fewer high-paid people employed than there were on January 1st, but more generally across the economies of the world, not only the Western world, not only the world where derivative markets have proliferated, but the consequences more broadly.
Yes.
And I think there are several lessons now that can already be drawn. The first is that the markets that we have celebrated since the days of Thatcher and Reagan depend for their continued existence, for their basic functioning, on political institutional and policy moves that come from outside the market. In Britain, on September 22nd of 2007, we saw the first retail run on a bank since 1868.
Northern Rock.
Northern Rock. In Cambridge.
Or some would say Crocker.
Yeah, right. Northern Croc.
Yeah.
In Cambridge, there were lines around the block.
Yeah.
People trying to get their money out before the bank closed,
Yes.
and thereby forcing the closure of the bank.
Yeah.
Here, we had the extraordinary events in the middle of March when Bear Stearns went from being a liquid functioning fifth largest member of the financial markets to being in liquidation. And it was, I think all direct participants and observers agree, if the Fed had not extended its operations beyond its legislative mandate to fund the acquisition of Bear Stearns by J.P. Morgan, Lehman Brothers would have gone down the next day, the fourth largest. And who knows what would have happened on the day after that. So that's the first lesson.
It's worth mentioning to the group that you and I both agree that Ben Bernanke is doing a damn good job.
Well, I think we should take a moment there. I agree with you. Bernanke, you may have seen in the Wall Street Journal a week ago, Monday, there was an article about, I think the headline was Bernanke's Bubble Babies. Bernanke was chairman of the Department of Economics at Princeton at the time when the Bentheim Center of Finance was established. Princeton has the tremendous benefit of not having a business school.
I should mention also valedictorian, Princeton.
Well, long time ago, and the lowest grade average of any valedictorian up to my time. But Bernanke had the ability to create a working group of financial economists who were unencumbered by institutional divides that typically separate the business schools where the finance guys live and the economics department where everybody else does. So this team, it was very well written up in the journal. It was an outstanding article. It was not, therefore, by definition, in the editorial section of the journal. And, and I urge you all to go take a look at it. Bernanke himself made his name academically doing something in a series of articles, academic articles, that you might all believe was so trivial as to be unworthy of notice, let alone of academic prowess. He wrote a series of articles that demonstrated conclusively that what happened in Wall Street, in the financial markets from 1929 to 31, and then in the banking system from 31 to 33, actually had a real effect on employment, production,
on real business.
Profits, the quote, real economy.
So the financial world had an effect on the real world.
And of course, as I say, you might think, well, why is that meaningful? Well, the answer is that in mainstream modern economics, as we've discussed in previous conversations, the world of finance and the world of the real economy are fundamentally decoupled to the extent that the mainstream macroeconomic models provide no channels within the structure of the models other than the interest rate for what goes on in the financial markets to affect what goes on in the real economy. Now, we're the beneficiaries of the fact that Bernanke, probably the leading macroeconomist in the country, who knew that was wrong.
Yes.
And knew that a preemptive strike.
He knew the risk involved.
Exactly, to head off the devastating impact, or at least to cushion the devastating impact of what was going on in the financial markets could and most likely would have on the real economy. Now, the other thing we know...
Let me inject something here, because I think it's important. And we talked this last night. The first year that he was in office, he didn't do anything. And to a lot of people, I think, it looked as though a deer in the headlights. Nothing up, nothing down, nothing to say. And the fact that he's gone from, that looks pretty wise in retrospect. And the fact that he's now become almost an activist judge, you know.
Oh, he's been very activist.
Shows that he actually had the equipment, he was paying attention, he knew what was going on, he properly did nothing when nothing was to be done, and when there was something to be done, he had the guts to do it. Okay.
Now, there are limits to what the Fed can do.
Yeah.
And we also have to remember that as we're now in the position of learning, and no one knows in advance, learning what in fact will be the magnitude and the pattern, the distribution of the shortfalls in cash flow as mortgages are defaulted on, as the banks reduce their lending to everybody, as credit card payments become stretched and defaulted, et cetera, and where we come out over the next 6 to 12 months. And of course, this happens to be at a time when the administration is in receivership. It is not reasonable to expect any coordinated executive legislative initiative. We have a useful possibility of a relatively marginal intervention on trying to ease the impact of foreclosures on homeowners. In fact, my own view is it won't hurt, it'll help a bit, but it won't have a broad macro effect.
Right.
But there's a deeper lesson, and this is what we put into the final title for the conversation. And that is the significance of what's gone on since last July for the foundations, for the assumptions, the framework within, for 40 years, economists, practitioners, finance professionals, and everyone else around has been the intellectual framework for thinking about the financial markets, the capital markets, the financial economy. I have to tell you
physics.
I have to tell you that when I left academia in 1970, I really did not think I would live long enough and that the neurons would still be talking to each other when the world proved to be as recalcitrant as I was sure it would.
Yes.
That the attempt to reinvent economics as a branch of physics, and particularly financial economics as a branch of physics, that would fail.
Yeah.
And we're not going to have an enormous amount of time to go into this, but this is the point at which we have the reading list.
Yeah.
3 books.
Okay.
3 books for everyone interested in this story. 2 books by prime practitioners who helped fashion the revolution that produced $45 trillion worth of credit derivatives, that produced this incredible proliferation of financial innovation. First book by a fellow called Emanuel Derman, professor of, originally PhD in physics from Columbia, now back at Columbia by way of Goldman Sachs. His book is called My Life as a Quant. Second book, Richard Bookstaber did his PhD in mathematical economics for Paul Samuelson at MIT, Morgan Stanley, and then Salomon Brothers Citigroup. He claims that he got to Morgan Stanley in time to make his first effort at destroying capitalism in 1987 with portfolio insurance, and then got to Salomon in time to play a critical role in the attempt to destroy capitalism in 1998 with long-term capital management. He's now retired to Greenwich with his own hedge fund. His book, appropriately enough, is called A Demon of Our Own Design.
That's good. That's good.
And then the third book, which is by...
He didn't say my own design. He said our.
Shared responsibility.
Okay.
And the third book is by an academic, a sociologist of economics, named Donald Mackenzie at the University of Edinburgh. And this book is called An Engine, Not a Camera. Finance theory, as it evolved in the 50s and 60s, was not a camera presenting a representation of how the financial markets worked. It was an engine for transforming how they worked.
Yeah.
And it takes the story from modern portfolio theory and Harry Markowitz and mean variance, the efficient frontier, through Black-Scholes and option pricing, right up to a year ago. So we're right on the edge. And you read those 3 books, and there is no room for surprise that we should have had finally this massive discontinuity.
Yeah.
And all three of these fellows have implicit, and in Bookstaber's case, it's really explicit, is that at core, what it took a generation of practice to teach is that, you know what, we've applied the derivative equations taken from physics that describe the behavior of molecules. We've applied them to the behavior of human beings. Molecules, human beings.
Yeah.
Yet molecules don't observe each other's behavior and change their
I think
own
it's going to be a long
accordingly.
list. Going to be a long list here
Yeah.
of what they don't do.
That's right.
Yeah.
And the great challenge going forward, which gets me up in the morning and bright and singing and happy, is to reestablish financial economics as a social science. But there's going to be a lot of Schumpeterian destruction in the intellectual marketplace as this goes on.
Yeah.
The kids in Economics 102 and first year of business school, they're going to be taught this crap, for another 20 years.
Right.
While
We'll be paying for it.
Oh, we'll be paying for it.
Yeah.
And then, if they continue long enough, they'll be taken behind the curtain and told, that's just to make sure that you can think, that you can solve differential equations and
Now,
do
here's how it
linear
really
algebra.
works.
Now, this is why you have to unlearn all that stuff and start mastering game theory and get beyond the stuff that you can do and I can't. Exactly.
Yeah.
You have to learn about talking to psychologists and sociologists and anthropologists.
Right.
So the deep lesson, as I say, of the last 9 months is that economics, finance are not branches of physics.
Yes.
They are social sciences.
Yes.
They are embedded in a
human
much
behavior.
broader matrix
Yeah.
of networks of relationships. People who've been bitching and moaning about politics and politicians and the political process, and why don't we just let the market solve it all, are again in the process of learning why we have politicians, why we have political processes, so that there are avenues of appeal from the market, not just for the losers when the market works well, but for everyone when the market ceases to work at all.
Right.
And that's where we are today.
Well done. Very good.
So you want to talk some about where the economy goes from here.
So I'll explain what we're doing because this is kind of different. We've never done this before. So there are three of us on stage. So now I'm going to turn and be, instead of the interviewer, the interviewee, and we'll talk for another 15 minutes about that, and then we're going to open it up to you and I both, and Michael, and to the audience.
And we will have the challenge, because for 15 minutes, people are going to see me sit here and not say a word.
First. We'll see. Michael.
So I'm Michael Copeland. I'm with Fortune Magazine. I was just here because it was good for taking notes. So in case
Can they hear your
I don't think you're on.
microphone?
It's on.
We do a test?
Test, test.
Microphone.
Better?
Anybody home?
Test, test. Anyone?
Do you want me?
Hello? Okay.
Okay.
There we go.
Thank you very much.
Yeah, Bill already talked, so there goes that bet. In the spirit of we told you so, I wanted to talk to you, Mark, for starters, about two fundamental dynamics that you saw. That's why we're here before everyone else. And maybe we can start first with your sleuthing at the Bank of Japan last February and what brought on this liquidity crisis, and continued sleuthing where we are now.
Okay. This is a good detective story, I think, if you like the whole issue of global economic danger. I was watching the markets, which we all do, and there was a very large event that happened in the end of February. Global equity markets dropped by a lot, simultaneously one day, and in a way which is very unusual. And I was trying to figure out what had caused that. You read the newspapers and they're always wrong. So what the newspapers originally said was it was caused by a change in the reserve requirements in Chinese commercial banks. There was no way in hell that was the cause. There just wasn't enough money involved. So then what could it be? The only other event that happened on or around that day was that the Bank of Japan, for political reasons, had made an unannounced bump in their rate. I think it was a half point, which is a huge thing for them to do. they generally just don't do anything. They sit there at a rate which is effectively zero or sub-zero. And so I thought, well, this might be about the carry trade. And the reason this was interesting was because it occurred to me that there was so much liquidity out there, and people don't have a good understanding of what liquidity is. It's one of those things that's kind of off the radar of the normal person. They worry about interest rates, and they worry about costs and GDPs. They don't worry about liquidity ever.
Right.
So it's one of those things that could creep up on you quite quietly and yet be huge. And I thought, is that happening here? So let's go back through the detective part of this and figure out why Japan would matter. Well, Japan has this thing called the carry trade, where you get, what I say to people sometimes, if you could borrow money at 0 and lend it out at 5, would you like to do that? And the answer is always yes.
Yes, please.
Well, that's what's been going on. So the way that most newspapers tell the carry trade story is it's orphans and widows and stuff in Japan. It's very restricted, and it's only allowed for untrue. So if you're a sophisticated investor, there are a lot of ways of getting your hands on that money. And this was happening during the growth of these big private equity funds. And you ask yourself, what are they doing? What is Blackstone doing? What is Carlyle doing? What are all these guys? What are the sovereign funds doing? No one really fully understands that. And it's partly derivatives. What are the hedge funds doing? There's a lot of money out there that isn't regulated, that isn't tracked, and there is no administrative overview. There's no regulatory agency globally to take a look at this. So there's a lot of debate about, even today, about how big is it and what is it. No one really knows.
How big the carry trade overall is?
How big is the carry trade? So that was the first question. Is this big enough to have done what just happened yesterday? And if you believe, the FT was the first on the game, and they said they thought the carry trade was $250 billion. And I thought, well, that's too small. I had another way of measuring what was going on, and that was I looked at the currency exchange rates between the yen and the dollar. And I know that the Bank of Japan, is happy to intervene and does so on a regular basis. It's a completely non-free market. They manage that number to allow Japan to be a strong export economy. That's their job. And if you looked at that ratio, the yen-dollar ratio, you saw a classroom, school book picture of intervention. I had guessed that during that year, 2007, they had allocated a lot of money to do this, meaning maybe $350 billion, $500 billion, a lot of money just for intervention.
Right.
It looked to me like they spent most of that in about 4 days.
They just flipped
And what you saw were 2 huge spikes where they intervene, bang, the number goes up, and then immediately the market pulls it back. And they intervene again, and bang, it goes back up, and then immediately, so you can't fight the river, right? And they pulled back and stopped. And then the story continues. So whatever this thing was, if you picture a rock and a lever, their lever was too small.
Right.
Now, if the lever is, say, $500 billion, or maybe a little more, that's too small. Okay, then the FT is wrong. The carry trade is not $250 billion, if that's what's causing this. Well, roughly, how does it feel? It feels like it's a lot bigger. It's not almost the same size because of the way that they got punished when they were trying to intervene. So probably the answer is it's $1 trillion or something bigger than that. So that was my guess, $1 trillion. Well, at $1 trillion, now you're starting to play real poker here.
That's a lever that can possibly work.
Yeah. If you said to me, somebody who's controlling $1 trillion just got nervous and sold all their stock, that could have had a roller effect.
Yeah.
And in fact, now we know the number is actually, depending upon how you count it, people have tried pretty hard, and you get one number which is about $3.5 trillion, and then you get a larger number which is the whole derivative story, which is about $62.5 or $67.5 trillion. This stuff tends to be tied self to self, so it's a pyramid of cards, and the reason there are 2 different numbers there is because there's kind of the real exposure, but then people build risk upon risk upon risk, and the whole thing comes down if the base collapses. You want to collapse the base, you raise the BOJ rate by half point without warning anybody.
Right.
So at that point, I was convinced that the real problem had nothing to do with China, had nothing to do with the global equities fall of February. We got a much bigger problem here. We have 62 trillion, or whatever the number is, of money out there that nobody's watching, nobody's aware of, which has been the story of liquidity of the global economy for the last 3 or 4 years. It's powering all these private equity guys and all the hedge funds, but nobody's paying attention. And if at the drop of a Japanese hat, the whole thing could, right? What would happen if something real happened? How vulnerable, how fragile is this structure? And so at that point, I went on to CNBC. I was already scheduled to be on these two programs, CNBC Europe and CNN World News, to talk about something else. When it kind of like the light bulb went on that morning, right? And I remember the interviewer kind of, the jaw dropped. You know, I said, well, basically, it looks to me like we're in a liquidity crisis coming up, and I don't know what's going to trigger it next time, but this is what triggered it the first time, and it's extremely dangerous. And she said, they brought me back for the first time ever on CNBC Europe. They have a rule you can't come back twice in a week. And she said, what do you do? And it was simple, cash. I mean, what do you do? Cash. And even that's not a great answer, but that was the best answer I could think of.
And in your sleuthing since, is the pain over? Is
No.
Bernanke doing his job, and the Bank of Japan and the Bank of Europe, and
Yes. So Bernanke is doing the best job I think he could do. As I mentioned last night, I think things are out of his hands to a large degree. There are externalities which are affecting the U.S. economy as well as the global economy that he has no control of whatsoever. That's kind of frightening, because in the past, the U.S. has had a lot of control over its own economy, and we've led the world. Well, that's not happening anymore. And yes, the Bank of Japan, as far as I can tell, the Bank of Japan learned real fast. They didn't discuss it openly, but they've changed personnel, and they've publicly announced there are no plans in the near future to do anything with the rate. In other words, what I'm hearing is we learned the lesson of unannounced, and we're not doing the unannounced thing anymore, and we're probably not going to raise anything anymore. So they learned. But the big problem remains the exposure. So there's all this risk out there. There's all this, it feels as though there's this credit crunch, but in fact there's a lot of money out there that's still in the same category. There's still all these derivatives upon derivatives on a global scale. And the sad part of this is you think, well, people will learn, right? The traders are going to learn. They'll see what happened to the other guys and pull back. I don't think that's true.
I mean, if it's all this money piled derivative upon a derivative, like a house of cards, like you say, where is the sort of weakness next that you see? I mean, which house of cards falls next?
Here's the scary thing. I mean, who would predict that Japan would make an unannounced, stupid move? They're very smart normally. So what's the next event? Is it a Sarajevo assassination? There are all kinds of triggers that are out there in the world.
And there's this teetering house of cards.
What you've got are a bunch of guys who are highly leveraged. We had one place in the U.S. was 33 times leveraged. And they with a good reputation, right?
Right.
They're supposed to be the experts. So if you get people who are really leveraged to the hilt out there, what is it that would scare them? Back into a more conservative investment position.
Right.
Could be almost anything. And so the answer isn't wait for the trigger to go off. The answer is pull these guys back while there's still some breathing room. Reassess what they're doing. Get some control over what's on top of what. How much of this stuff is real and how much of this risk is just double, triple, quadrupled.
Right.
We saw the edge of that with the subprime problem. There's much more than that available globally, I think. So it requires that nations talk to each other and form some kind of a regulatory overview that will discourage that kind of behavior.
Another dynamic that you saw early on in this economy, or this faltering economy, is this bifurcation of the economies. You called it a local and a global economy. And many people in this room sort of benefit from that bifurcation. But one is how technology, you think, will lead us out of whatever recession we may or may not be in the United States. But that dynamic, if technology leads us out, where does that leave the rest of the economy? Mm-hmm. And you called this, I think, I don't know, when? February?
I forget. It was.
But in the intervening months, we've seen, positive reports from companies like HP and Cisco and some others. And so it seems to me that the evidence is piling up that, yes, indeed, there is two economies operating in the United States. Yeah. Describe that, and also what the evidence you see piling on is right now.
So I think that it is true that we have a split economy now. It has surprised a lot of people. They still don't have the right language for it. They're still talking about averages at a time when they ought to be talking about two worlds. And you can't make blanket statements any longer about the U.S. economy. If you take global exposed technology companies of a good size, they're doing really, really well. They're benefiting from some deep trends that aren't going to go away.
Such as?
A huge increase in spending in the emerging world on IT. Huge increase in numbers of consumers of IT services and communication services. Huge increase in content offering possibilities. A general requirement for coming to be like the United States. So all the stuff that we've built, people want. And you're talking about 1 billion more people or more wanting that. So they can't necessarily have it all tomorrow, but they want it all. And as time goes by, they'll get it. So that is a long-term, multi-decadal story, which is very good news for anybody who's got salespeople in 188 countries. So that's going to sustain global companies that are in the IT world. But at the same time as that's happening, if you ask, how about construction, finance, and related industries?
Anything related to credit, probably.
Yeah. So you read these things in the newspaper like the worst part's over, as though there is an average and as though it's done.
Right. I mean, yesterday was described as, or yesterday or the day before, as a saucer, right? There was this survey of economists, and they're saying, well, it's a saucer. We're going to have a shallow dip, we'll flatten out next year, and then we'll rise a little bit. You think that's the wrong way of looking at it?
I think it's 2 drawings, not 1 drawing. Instead of one saucer, it's 2 lines. These guys are going up, these guys are going down. You can call that a saucer if you want to, but these guys are screaming with their fingernails going down the blackboard, and these guys are going to the bank.
Right.
So I think if you care a lot about real estate and those other, finance, construction, it is extremely frightening. There's so much inventory of real estate that has to be worked through from the speculative bubble. There's so much stuff that's still coming on the market in the condo markets because they have to do that to get their loan money. They're building into markets like Miami, San Diego here,
right,
where there's already a glut. They have to add to the glut because they won't get their construction loan back. This is going to take years and years to work through, and we're already seeing prices down like 17% on an average. So it's not over for those people, and it's not going to be over for 2 years, let's say, and probably more. It's probably a 5-year story.
So, Mark, my 15 minutes of silence are over, and I overfulfilled my quota. Let me just go back one step with you. And this is where the good news is the bad news. I mean, the good news is the deleveraging of the financial system across the Atlantic is underway. Mm-hmm. It is taking place. It's represented visibly by the succession of major banks taking major amounts of equity capital. Mm-hmm. Most recently, AIG said they were going out for $12.5 billion, and then they decided, no, you know what, it's going to be $20 billion, which gets them up towards the Citibank level. Mm-hmm. There is certainly a hole that is still not quantifiable, mm-hmm, that needs to be filled, and it does go with this story of leverage. Yeah. And it's
if the number is 67 trillion over here, and 9 billion over there.
The 67, there are two very different issues to separate out.
Yes.
In a way, House of Cards is sort of the wrong metaphor. Daisy chain is a better metaphor.
All right.
Because you have people writing contracts against each other, mm-hmm, which net out to a very large extent. So JP Morgan Chase, which, mm-hmm, invented credit default swaps, has a net exposure to the credit markets of something, reasonable for $1 trillion balance sheet. It's something in the 50, 70 billion. The trouble is, it's 3.5 trillion gross. Yeah. And the challenge is is counterparty risk.
That's why I mentioned those two numbers.
Yeah, it's counterparty risk around the daisy chain.
Yeah. Right.
If somebody doesn't pay, then, and that's what happened with Bear Stearns.
Yeah.
And that's why Bernanke had to intervene to protect the system from one of the major players in that daisy chain defaulting.
Totally agree.
But
we still have 3.5 trillion sitting out.
Oh, absolutely. Yeah. Absolutely. And against that, they have, They're leveraged about 10 to 1. And, well, they're leveraged about 14 to 1. They want to be leveraged about 12 to 1. And that's why they're all raising capital. But as the deleveraging takes place, it doesn't just mean there will be less demand for paper. It will feed through to less demand for bricks and mortar.
Yeah. Yeah.
Less demand for goods and services.
That's right. That's right.
And that's where we cannot, I agree with you completely.
Yeah.
We do not know
Yeah.
how deep and prolonged
Yeah.
the recession will be.
Yeah.
We know that in Japan, it was 10 years,
10 years
not
off
2
the
years.
Bubble. Yeah.
10 years of slump, of rebuilding the financial health of the banking system, which is still somewhat problematic
Yes.
in Japan,
Yeah.
with massive amounts of bailout money for corporations. Here, we're going to have, I think, two parallel processes which politically are going to get very complicated. One is, whether or not you want to call it bailout, let's call it relief, like the Dodd, the
Subprime story.
yeah, the story
Mortgages.
about the bill that now the House and the Senate have sort of reached agreement on, Barney Frank and Chris Dodd's bill, which Bush is threatening to veto. If he vetoes, the Republicans will override his veto. They really don't want to lose 50 to 100 seats in the House
Right.
in November.
Yeah.
But that is a step that will be more symbolic than
Yes.
substantive.
Yeah.
The second question is, well, what do we do about this going forward? And one of the phenomena that is now notable, at the same time as Wall Street is laying off people, Wall Street is reducing its exposure to the derivative markets. Wall Street, broadly defined, which means the city of London, it means Amsterdam,
Gotcha.
it means
Yeah.
Zurich
Yeah.
and Geneva as well,
Yeah.
are all not rolling over credit. They're hoarding cash to protect themselves.
Yes.
They are also talking in a way that nobody has heard for a very long time about their need for more regulation to protect them from themselves.
Wow.
The two items that you will probably hear discussed, one is to take the credit markets that have become over-the-counter, customized, special, just for you, which means I can charge each of you more,
Yeah.
and bringing
All
them.
that slicing. Yeah.
Yeah,
Right.
and this is
Yeah.
where the credit, the
Yeah.
counterparty
Yeah.
risk
Yeah.
arises.
Yeah.
If we bring them, if we require that they be standardized and traded on an exchange
Yes.
and settled through
Yes.
a clearinghouse,
Yep, that's right.
we eliminate the risk of a counterparty failure.
And you also gain information.
You reduce the profits of the
That's right.
banks
That's right.
to the extent that you get more
That would be the whole
transparency
point. Yeah.
and more information. The second is we moved from, a 1,000 years of capitalism where you originated the loan, you lent the money, and you held the debt, and you cared about whether you got repaid, right? That went out
That's
the window.
gone, yeah.
That went out the window. And we
That
went
was
to
the first leg that the Fed lost.
That's right.
When the Fed, this is half true, that
Yeah.
the Fed used to have control of the banks because the banks were loan dependent.
Yeah.
And when they would expect the banks to follow
Right.
their lead, which
Right.
they stopped doing when they switched over to fee-based.
originate and distribute
Exactly
and
right.
collect the fee.
Yeah.
So one of the items of reform that is being very broadly discussed is if you originate a loan, you have to retain the first, say, 20% of loss. You cannot
So you
hedge
share the
that.
pain.
You cannot give it away. You are on the hook, which means
Good.
you're going to pay attention.
Good.
Which also means your potential for loss and your
It's on your books.
risk-adjusted profits will also go down.
Yeah.
Do those reforms and their likelihood of their passing or not, or being enacted, depend on the upcoming election?
Sure they do.
Yeah, they do.
And to what extent?
I
Which side?
want to throw something in here. We'll come right back to that.
Sure.
But you've driven the truck right up to a big door that I wanted us to cover, and that is, it feels to me as though in the last, 3 years, but it's probably 5, that the U.S. and global economy have acquired a drag, and the drag comes from these financial engineers. And if in a perfect world the farmer makes beets and the broker buys the beets and then distributes them to Safeway, we now have another 5 layers of those guys. And they don't make beets, and they don't drive the truck, and they don't have a store.
Well,
And
but
so
here,
now just let me finish.
Yeah.
So, the question is, are we paying, And then there's volatility in this, because the more volatility, the better if you're a trader. If you can enhance volatility, that's good. Bad for the customer, good for the trader. And I think exactly that is happening in a lot of markets. And so are we paying a combination of volatility tax and trader tax that has no productive benefit in the actual supply chain?
Well, here's the thing, and this is why what's going on in the financial system, in the banks, and the capital markets really matters to your primary theme for the conference, rapid response to climate change. We need, as Vinod laid out, we need to spend a lot of money. We need to invest a ton of capital. It is not all going to come from the government. It is going to involve investing in a lot of, let's call it, be polite and say, frontier technologies, some of which aren't going to work.
Right.
Or if they work, they're not going to be economic.
Right.
There's going to be a lot of waste on the path to dealing with climate change, not only in terms of alternative energy, but in terms of increased efficiency. We need functioning capital markets
Yes.
which, as we did with
Really
the laying out of the internet
functioning.
and the building of the great bubble of the 90s, where we built an internet that we didn't know what we were going to use it for, and we funded 1,000 hopeful monsters and discovered out of Amazon and Google and eBay, hey, guess what? There is something we can use this stuff for. It was very
I actually
wasteful.
have to think that if we had had the broadband that the Telecom Act of '96 had provided for, all those companies that went away would have stayed.
They had,
or many of them.
Pets.com would not be here, I promise
It's
you.
back, that's the
I
thing.
promise you.
I think, in fact, it would be.
I don't agree.
But not having any bandwidth, there are no online ad revenues, and that's what collapsed for those guys.
Well, maybe,
Yeah.
but I do think that we need a financial system and financial markets that are in business to accept risk, to be wasteful, to be a resource for funding innovation, which by definition is a Darwinian process.
We need to stop wasting money
That's right.
in a non-productive way and
And
waste money in a productive way.
And the danger is that we're going to be stuck for a period of time,
Yeah.
as the Japanese were.
Yeah.
That we're going to have we already have huge increase in risk aversion. Visa can go public. Do you know anybody else who has recently? The willingness to commit capital when you're going to have to live with some of the loss, you can't just automatically assume you've laid it off. That is the real drag that I see slowing down the rapid response to climate change. It's not a shortage of ideas. You just look at Vinod's portfolio, and his is only a subset of all the alternatives out there for addressing this.
Right.
But we're going to have a rapid response at the level of innovation, a slow response at the level of investment.
Yes.
And that is, I think, very
I think
troubling.
You're absolutely right about that.
Yeah.
So, and we still haven't solved this problem of, do we have this tax? Somehow Wall Street will have to correct itself, as you say they want to, so that less of that money, that capital goes into, all right.
I think we're in sync.
I think we're in sync. Once again.
Questions? Should we
House
open up?
lights?
Michael Pfeffer, Kolohala Ventures. Two questions. One, could you discuss a little bit the role that sovereign funds have played? And then the second question is, I think hedge funds are about $3 trillion in aggregate, but those are closed-end funds. And will they get caught, some of them, as they try to create liquidity for their investors, but conditions have changed, they could get in real trouble and start dumping a lot of assets, like hotels that they have a lot of that.
Well,
Can you talk about that a little bit?
Two different things. Sovereign wealth funds actually tend to be very conservatively managed. And they tend to be a little bit like the Japanese in the 80s. They look for brand names. They put money into Citibank. They probably don't do a great job of assessing whether they're paying too much or whether they should wait a month. They are a huge pile of cash which is beginning to diversify away from U.S. Treasuries, which obviously has had implications for the value of the dollar. They will be conservatively invested, in my view, and over time they will provide. They will be part of the conversation about how we refinance a financial system that is illiquid with many members of it that are
In fact,
insolvent.
they appear to be an integral part of that
That's right.
conversation.
That's
and
correct.
The very first phone calls were made to Dubai.
Right.
And it
Correct.
looks as though we were going to have a whole new set of shareholders
Now,
in New York.
I do think we can be thankful that the epicenter of modern finance and financial innovation had not moved to Dubai, because if their Bear Stearns had gotten into trouble, I don't think
Well-
Bernanke would have been in the position to reach out.
We know the
Yeah.
guys who tried the first IPO in Dubai, and that was a mess. So that didn't
So
happen.
they've got a way to go. On the hedge fund issue, first of all, remember, hedge funds, the term hedge fund defines a compensation system, not an asset class. You have everything from, small, intensely focused equity investors to guys doing statistical arbitrage across every imaginable market, to guys like, who are just in the business of shorting whatever moves and generating whatever story they can to validate
Yeah.
the short.
Yeah.
There are hedge funds already going bust every week, dumping the assets. The assets are almost never real assets. They're financial assets. Hedge funds don't own a lot of hotels. They own a lot of paper issued by people who build and own hotels. My favorite example are a couple of really smart guys out of Goldman Sachs who were up 87% last year in London by getting the mortgage market right. They shorted the subprime and
Oh, yeah.
Alt-A mortgages,
Goldman got
up
rich off that.
87%.
Goldman just made a killing off that.
In 1 week in March, they decided that it was over and that they could start going long the higher they were wiped out in 1 week.
1 week.
Ouch.
Live by the sword. You don't die in a
I
warm
think we're-
bath. I think we're done.
I think we're
Closing
done.
up on
Yeah.
time.
Thank you very much, Bill.
Great.
Thank you, Michael.
Thanks.
Michael.